Hi, good afternoon. How's everybody? Hello.
Good afternoon.
Hi, DeAndre. I see how many people are here. Five. What? Only five, actually. um, I'm disappointed, but I'm not surprised because um, you guys may have noticed that in the assignments folder, right? I've updated um, quiz one and midterm result. And then this time, the midterm, not um, a lot of people uh, didn't take midterm. I don't know why. Um, so, okay, considering, so look, quiz one, the 14 people, oh, it's still 14. So it's not that, no, that I don't know why there's no quiz two or final yet because this somehow tagged along from the old, uh, like previous. I'll have to fix this previous, semester. But as you can see, the number of people that took midterm, uh, yeah, there were 14. So the number stays the same. Uh, but so anyway, oh, how do I get out of this? Okay, so bond. Let me open. I wonder if I have downloaded bond valuation. Yeah, let me open that. Where is it? All right. So we were talking about the we were talking about how the bond prices are quoted last time. Um, Again, bond prices are quoted as percentage of the face value, and the face value of all bonds except for municipal bond face value is $1,000. So this can easily translate into 917.35. Corporate bonds use rather than decimal. I mean Treasury uses 30-second system. We talked about that. So how do we translate it? So it's 104% plus, right? 25 over 32 of 1%. So how we convert it, we talked about it last time. It's not really a difficult thing. Now, Treasury And you know that the Treasury is the safest bond, safest asset in the world. We talked about that in topic 1. Treasury is the safest asset in the world. What is this? Oh, uh, I thought it was under. Okay, opened separately. So there were 5 people. So let me check how many are in here. So 7 people. Yeah, 7 and 7. So where are the rest of the? At least we have like officially almost 19 people on the roster, 19 or 18 people on the roster, and then at least 14 people took midterm, right? So there are still. So if we are only 7 and now one person one person left, I think probably the internet connection. So still,
Good afternoon, Professor. You can hear me now?
yeah,
Uh,
yeah. Hi, Sarah.
Hi.
Hi, glad to see you back. Because I thought, I saw your connection dropping a while ago. Um,
Yeah, my
yeah,
internet is not
yeah.
working.
Hmm. So I'm wondering, where's the other half of the class? I mean, 14 people took midterm, so that means at least there should be a. Okay, we have 8, so we're still missing 6. Anyway, so where was I? Wait a minute. Where that PDF? Okay, that PDF file viewer is here. So as you all know, Treasury is the safest asset in the world. But say the other side, the flip side of the risk-free asset, uh, the flip side is that they pay very little return. And we saw that even, and I told you this was 2010 when they took this when they took this data. At that time, around June of 2010, coupon rate, Treasury coupon rate was 2.75, and um, Treasury doesn't pay more than much more than this. Even now, look up like 10-year Treasury note, and this you see the maturity date is February 2013. Okay, and then what is that N next to it? That means this was originally a issued as Treasury note. Yes, of course. Even with 2 years, 3 years left, still it's got to be Treasury note. What else? But what this means is was originally Treasury note has 10 years. Um, 10-year maturity, right? Maximum maturity that the Treasury note can have is 10 years. So it was originally a 10-year Treasury note. Um, uh, it wasn't Treasury bond. I mean, what I'm saying is uh, the bond, think about 30-year Treasury bond, 30 years, right? So if 20 years have passed, right? What does that mean? It has only 10 years left to maturity. From that point on, it becomes Treasury note. In other words, Treasury bond, Treasury note, Treasury bill, these are basically they don't have names, bond, note, bill specifically written on it. It just says Treasury on the face of it. It says Treasury. I think it says Treasury, just Treasury Department. They don't say specifically bond or note or. I can do a quick search. Treasury. So basically, collective name is securities. Images. Oh, what did I think I accidentally closed it. So the point is, don't have time. So the point is, the bond the bond can be born. I mean, the Treasury bond can be born as a 30-year bond. But once the time passes, when the time passes, right, 20 years have lapsed, then it will have only 10 years left to maturity. One more year passed, only 9 years left to maturity. Then it's not called a Treasury bond anymore. It's called a Treasury note, right? And traded as Treasury note. In other words, once it has less than 10 years left, then it is Treasury note. And even that originally, the bond that was originally born as 30-year bond, when it has less than 1 year left, then it is traded as Treasury bill. Of course, what else can it be? If it has 1 year left, less than 1 year left, then it will be traded just like Treasury bill. But the point is, the point I'm trying to make is 2 points. Even these days, Treasury bond, Treasury notes, they don't have more than. They are just about giving this type of coupon rate. They don't. But then think about it. This coupon rate is too little. Think about it. When we all know this year, the inflation has, even reached like 8.9%, right? Around June, I think May, June, it was like 8.9%. And what does that mean? Real return on the Treasury is even negative. Isn't that right? Treasury gives, negative return. Negative real return. Right? If the currently, nominal, that's nominal. So nominal return is, nominal return on the Treasury, let's say 2.85. However, if the inflation is 8%, real return on the Treasury is, we all know, it will be negative 5.15%. So how can this be a safe risk-free asset? When risk-free means it's default risk-free, right? That means default risk-free. It's not it's not free from inflation risk. So what they because they pay such a low return, so what they came up with is tips. TIP stands for Treasury Inflation Protected Securities. So inflation protected bond, Treasury bond. And Treasury does this. Corporate, I haven't seen corporate bond doing this. I don't think corporate bonds do this, because if you want, corporate bonds have higher risk, so they pay higher returns. Some even high enough to even compensate for inflation. Some maybe not, but for Treasury. So how does it work? TIPS is indexed to inflation in 1997. So 1997 is the base year. But actually, in macroeconomics, 1982 through 85, like those 2 to 3 years, they generally serve in macroeconomics 1982 through 85. That period serves as the base period, base year. So all the inflation adjustment is based on that period. But then 1982 is like 1982 is 40 years ago. 40 years ago. So, and why that period? Because that was the period when U.S. economy suffered the greatest, stagflation in the previous decade, right? 1970s, was, really, really plagued by high inflation, but very low growth, hence called stagflation. And to fight that, Federal Reserve implemented a very massive, tight monetary policy. And so the interest rate soared, economy went through tightening, or in other words, there was significant recession, and that's the only way to cool off the economy. Only by 85, only by 85. So 82 through 84 was recession, and only by about 85, the U.S. economy rebounded. But in the other than 1929 Great Depression, in the recent history, 1982 through 84, that was the period of the very serious recession. But as I said, that was 40 years ago. That was 40 years ago. So as a recent benchmark, right, for recession, they used 97. So what happened in 97? I was, what they call Black Friday. Okay, Black Friday was the, there was a financial market crash in 97. And then, so think about it. When there's financial, financial market crash, then, economy freezes over, right? So that was the nearest recession, noticeable recession we've had. So if you think 82, using 82 as the benchmark for recession, the bottom of the economy, right? The bottom pit of the economy, or trough of the economy. And if you think using 82 for that is too distant, right? It's already distant past, 40 years ago. Then more recent trough of the economy was 97. So that's why they use that as the the baseline year, base year. So using that year as the base, federal government adjusts par value for inflation measured by CPI. Yes, as then think about it. CPI is an index. Index means the base year is 100. So 82, 84 is like 100, right? The CPI for 82 through 84 is 100. And then CPI for 1997 is like 200. 200. It's about like 200. So that means, between 84 and 97, the price level doubled, right? The inflation is 100% between 82 and or 97. That's almost like almost about 15 years, less than 15 years. But 97 minus 82, right, would be about 15 years exactly. The price level, so the price is doubled, during those 15 years. Now, so they make adjustment to the par value of the bond. What does that mean? Par value of the bond is $1,000. And then we all understand, because coupon rate, we understand that the coupon rate, if the coupon rate is 5%, think about it. That's 5% of $1,000 par value. Isn't that right? $1,000 par value. So annually, that means $50 annually. But if the inflation is 10%, this 5% is actually means nothing. Real coupon rate would be negative 5%, right? So we need to compensate for that. So if there has been 10% inflation, if you adjust the par value by 10%, the adjusted par value will be 1,100. Then the coupon rate 5% will be, if the coupon rate is 5%, the coupon interest will be 55, right? 5% of 1,100, right? Will be $55. So that way, there's a compensation. They compensate for inflation. That's the idea behind it. Okay. So here's an example. So consider a 10-year TIPS issued on January. Forget about 15th. Just January to January. That's January 2007, paying 2 3/8% coupon. So 2 3/8%, is 2 point whatever. This is 3/8 of 1%, right? So if, we can calculate that. So it comes to the percentage would be 2.375%. This will be 2.375%. So that was issued on January 2007, and at that point the CPI was 201, roughly 201. Let's just it's 201.66 something, but roughly 201. So oh no, what am I doing? So it's like coupon rate. I think this was the coupon rate. 2.735, and then CPI. Roughly 201, whatever, ignore that, just 201. And then 3 years later, oh God, that doesn't look that that doesn't look like 2010, but 2010, my handwriting. Excuse my handwriting. What was that? 3 years later, right? January 2015, CPI was 216, 24 something. Whatever it is. So 201, 216. So what does that mean? The inflation over 3 years, during these 3 years, was roughly about 8%, roughly. Isn't that right? Why? Because it's 16, right? The index CPI grew by 16, but think about it. That's 16 is, if we equate this, okay, if we consider this 200, right? It's 16 over 200, so roughly 8%. So to be exact, it would be 7 point something, right? Inflation is 7 point something. So the point is how to make adjustment. So right? How do we simply it's going to be like this, right? To make adjustment for inflation, you multiply the par value by 1.08. But to the point is to make this, to find this exact ratio, all you need to do is CPI of 2010 over CPI of 2007. This will give you whatever that may be. The exact number would be 1.07 something something, right? Then the par value will be adjusted, and then you multiply that by 2.75%. Then that will give you 1 year coupon interest. But coupons are paid, remember, coupons are paid semi-annually, right? Bond is paying interest semi-annually, so you'll need to divide it by 2. So here, so how they made adjustment to the par value. Par value in early 2010 will be this. How? 1,000 times CPI of 2010, right? 1,000 times CPI of 2010 over CPI of 2007. That will give exact number, and then whatever, I believe that comes to 7.231, right? Only why? Because this can be only explained by 7.231. Isn't it right? This one, if $1,000 turns to 1,072.31, that means this ratio is exactly 7.231%, right? So then this is the coupon rate, and if you turn it into a decimal, it's 2.375. So you multiply that to the adjusted par value, right? And then divide it by 2 because it's semi-annual. So this is how you make adjustment, right? For tips. Okay? Now, let's take a look at the municipal bond. So muni bonds offer lower rates because, the benefit of the muni bond is that its its interest payment is all tax free, exempt from federal uh, level. Uh, they may or may not exempt they may or may not exempt it from from taxation on the local level, or in other words state or city level, but at least federal uh, the interest paid on the muni bonds are tax exempt at federal level. So what does this mean? This is a very good instrument to park your money for a long time. Uh, but then generally individuals do not put their money in the uh, muni bond. Uh, it's usually the institutional investors, especially insurance companies. Think about it. Insurance companies have huge cash flow because every every day the insurance premium is coming in, right? And they have to manage this money well because um, the accidents generally, think about it, insurance accidents don't happen that often. Obviously, the cash outflow to pay for the damages um, is relatively small compared to the cash inflow, the premiums that come. But uh, but the insurance companies have so they have to manage this money well, and they so the best thing to do is, if you have to put it into stocks and bonds, of course, but the stocks are riskier than bonds are also risky too, but the uh, stocks are riskier than bonds, but bonds are relatively a lot less risky compared to the stock. And also, you all understand there's credit rating, right? If it is a triple credit rating is high, it's relatively safer. And muni bonds, I'm not saying muni bonds are all safe, uh, but because there have been instances of municipalities going bankrupt. First of all, in the early 1990s, the city of Bridgeport in Connecticut went bankrupt. That means they were not able to pay back the bonds that they sold. Uh, and also in the early 2000s, of California, state of California went bankrupt, right? So even the states and the cities can go bankrupt, right? Uh, but if it is like New York City, is there, default risk is very low because there's a lot of New York City has a lot of revenue coming in, tax revenue coming in, so it's rare. But anyway, the point is, muni bond the interest paid on the muni bonds are all tax exempt. So insurance companies who are real, that must uh, maintain they have to have uh, definitely a good return on their uh, cash holdings. So they invested in muni bonds, and especially TIPS and muni bonds. And the muni bonds, first thing, they are relatively safe. If it is New York City, uh, definitely safe, right? And but you saw that the muni bonds don't pay a very high interest. Once again, municipality, it varies by municipalities. New York City has absolutely, obviously, high credit rating, so New York City doesn't have to pay much, but still they paid about 4.5%, right? Um, but if the default risk goes up, then they will have to pay higher interest. And in case of uh, New York City, that was paying 4.5%. So here's the and this is tax-free 4.5%, right? So here's an example. If you have $100,000 to invest, and you can either put it into the corporate bonds or muni bonds. Okay. Uh, Also, you can consider Treasury, but the Treasury pays very low interest, so maybe it's not attractive to you. So you are torn between muni bond and corporate bond, and the corporate bond. Let's say the corporate bond pays 7%. Our example here, in this example, the corporate CIT group was paying 7%. But the muni bond pays 5%. So then you might think, 7% is better, so I'll put it into the corporate. But then you are not considering the effect of tax, because on corporate bond, on this 7,000, you'll have to pay taxes, whereas on muni bond, it's tax exempt. So after adjusting for taxes, uh, muni bond might win out, or corporate bond might win out, depending on at what tax rate. But let's say this investor is in 35% marginal income tax rate. What's marginal tax? Marginal means, anyone understand? Anyone can explain what marginal means? Hmm? Anyone? Marginal means, marginal means one additional. In other words, if you make one more dollar, right? If you make one more dollar, that's marginal income, right? So the more additional, I mean, each additional dollar you make, that's your marginal income. Incremental, marginal means, actually, incremental, right? By a small margin, right? Means by a very small margin. So incremental change is marginal change, right? Incremental change is marginal increase, very small increase. But additional, there is additional, although it is mediocre, it's still additional income. So marginal tax bracket, marginal tax rate means if I'm currently in the 30, if I'm currently in the 32% tax bracket, and that's my top tax rate, and if I make one more dollar, and if that one more dollar makes my income go above the current level, what should I say? If that $1 more pushes me into the next tax bracket, then that my marginal tax rate is the next tax bracket. But if it doesn't push me into the next income bracket, then my marginal tax rate is still 32%. So what I'm talking about is something like this. So let's say you all know the tax rate. That means tax rate. Maybe I should put it like this. Or EBT, taxable income, right? EBT. There are several tax income brackets. So and oh, what did I do? They simplified it to 5 brackets, but previously there were 7 brackets. And then, for example, if your taxable income is, so that means after, taxable income means for individuals, or after deductions and exemptions, right? And if your taxable income is something like this. And then, if there are 5 brackets only above, then, it's obviously above. And then for each income bracket, let's say tax rate is up to that 0, and then let's say 15%, 22%. Let's say tax rate is like that. If your taxable income is, let's say, if your taxable income is 140K, right? Then when you make $1 more, that doesn't mean you pay 32%. It doesn't mean you pay 32%. You understand? It doesn't mean just because your taxable income is 140K, it doesn't mean you pay 32% of that 140. What actually happens is your income is straddled over all these 4 different income ranges, isn't it right? So for this portion of your income, you pay 0%, and for this portion of your income, you pay 15%. So that would be like 25K, isn't it right? For 25K, you pay 15%, and then and your income also goes through this bracket or layer. So that would be like 40K. For 40, you pay 22%, right? Up to the first 15K, you pay, so this is, you calculate that in that tax dollar amount. And then you have this, for this bracket, you have 80 to 140, so that would be 60K, right? For 60K, you pay 32%. Okay? So your total tax will be whatever these numbers, sum of these numbers, right? In other words, you don't pay 32% of 140K. It's not like it's not blanket, right? It goes through those layers. So here's the concept of marginal. So currently your top tax rate is 32% currently, because your taxable income is 140K. So if you make $1 more, where does that $1 more fall into? What tax bracket does it fall into if you make $1 more? Anyone?
Is that just like a next income bracket?
So if you make $1 more, you fall into this income bracket, 35%. If you make $1 more, what is the next income bracket? I mean, the next income bracket to this one would be 35% bracket. Are you saying if I make $1 more, that $1 more will be taxed at 35%?
Yeah, I believe so.
No, no. Think about it. 32% applies up to 150K. So if I make $1 more, that $1 more will still fall into, I mean, my taxable income is 141. Still, it still falls to 32%. You understand? If I make $1 more, still it falls under 150. So it's still, 32%. Right? You understand? I believe you understand. So, and then, you see, the thing is, think, please, do not memorize, because you'll memorize, what is the marginal tax rate? Oh, that's when you make $1 more. You go to the next tax bracket. If you memorize it without thinking, then you will automatically think that, if you make $1 more, the next tax bracket is 35%. No, if you make $1 more, still you are still here, right? If you make $1 more, it's your taxable income is 141, and you're still here. In other words, until you make another 10K, your marginal tax rate is still 32%. In other words, if you make $1 more, still you will fall. But if you make 10K and $1 more, then from that on, you fall into this bracket. That $1 more, right? 10K, if you make 10K and $1 more, another 10K and $1 more, still that 10K will still fall into this 32% bracket, but that the next dollar will fall into this 35% bracket. That's the concept of marginal tax rate, right? So as long as you don't hit the ceiling, this upper bound is 150K. As long as your taxable income doesn't hit that upper bound, right, you still pay 32%, right, for the income between this 80K and 150K. I mean, so that means up to 70K, right? You pay 32%. But if you make $1 more, the next dollar will be taxed at 35%, right? So as long as your taxable income is 150K, your marginal tax rate is still 32. But if you make more than 150K from there on, the marginal tax rate is 35. So that's what it means here. So the investor is in 35% marginal income tax bracket. That means if he makes one more dollar, then it will be taxed at 35%. Right? Currently, we don't know currently if he is in 32% bracket or if his top tax bracket is 32% or 35%. It could be either one of the. Even if he is currently, if he is currently in 32% top tax bracket, but if the marginal tax bracket is 35%, that means if he makes one more dollar, any additional income will be taxed at 35% rate. It can mean that, or he may be already in 35% tax bracket, but any more income he makes, it will still be taxed at 35%. That's what it means, right? So if this investor has $100,000 to invest, and either in corporate bond or muni bond, if he buys corporate bond, it pays 7%, and so from $100,000, 7% is 7,000. It will be taxed, right? Taxed at 35%. So if we adjust that income, right? If we adjust that income, 7,000, right? Interest income, if we adjust it for taxes, right? So 7,000 times 1 minus 0.35, right? So that's after tax, right? After tax income is now, after tax interest income is 4,550. Whereas muni bond, it's only 5%, but you're not paying any taxes. So it's 5,000. So in this case, muni bond wins out. In this case, muni bond wins out because I'm gonna give some break to my throat because it's so hard to speak. My throat is so painful. So this is basically, how you make adjustment. There are two ways. One, you can convert taxable bond return into muni bond return, or is this one. Turning taxable bond return into muni bond equivalent, right? Muni bond equivalent, in other words, after tax. The other one is the other way around. You can turn the muni bond yield into equivalent taxable yield. So think about it. The math is very simple. So to convert corporate bond, you know what yield is. I explained that. Yield is the annualized return. So and yield is not just the interest, right? Yield is not just the interest rate. Remember, interest rate is only the like the rent in the house example. Remember, but just like in the house example, house values, there will be capital gains or capital loss. So also the bonds, there can be capital gains or capital loss. Most bonds, discount bonds, there will be over the life of the bond, there will be capital appreciation, capital gains, right? You paid like $800 for the bond, but at maturity you get 1,000, so capital gain. On the other hand, uh, the premium bonds are selling, premium bonds which sell above par value over the life of the bond, it will experience capital loss. That's only what it's supposed to be. And on the other hand, premium bonds enjoy high coupon rate. First of all, why is it selling at premium? Because I've been telling you, coupon rate is greater than the discount rate or the prevailing market rate, and vice versa. Discount bond, why is it selling below? Because it doesn't pay high coupon, and the coupon rate is even lower than the rate. Then it will have to be it will have to sell below par value. So if you want to convert corporate bond into equivalent muni bond, equivalent muni bond yield, right? What you need to do is simple. Oh, come on. How you do that? Multiply that by 1 minus the Greek character tau. That means tax rate, right? Corporate tax rate. Then that's the equivalent muni yield. Also, on the other hand, you can turn muni yield to equivalent corporate yield. All you need to do is then right. These two equations are just you understand they are flipped, reverse equations of each other, right? So that's what this is saying, right? Okay. Now, but again, it depends on the tax rate. If your marginal tax rate was not 35%, but if your marginal tax rate was 28%, then it will be a different story, right? And corporate bond provides more after tax. Okay, so I think that it's 7:02 now, so I think it's a good time to take a 10-minute break. So let's take a 10-minute break and reconvene at like 7:12. So okay, let's take a 10-minute. I think I can. So many things. All right, we're back. We're back. So where was I? What happened to my? Did I? Oh no! What happened to it? Did I close it? Okay, looks like I accidentally closed a lot of. Hmm. Okay, let me reopen it. I thought I just minimized it, but it doesn't. Okay, it's there. It takes such a long time. And when you, okay. And the white. Okay, the whiteboard is there. It's just that and what happened to the? Oh, come on, please open. Let me try opening it. Oh, no, not share. Okay, please bear with me. This thing is taking so much time, and uh, okay. So we already understand a lot about bond basics, right? Bond is a standardized debt instrument. Therefore, what are those standardized features? Understand, bond face value or maturity value or par value or redemption value are $1,000, except for the municipal bond, because muni bond has $5,000 face value, and uh, the face value goes by different other names, but you must recognize them all. It's also called par value, right? Uh, or maturity value, right? Or redemption value, right? Um, and then bond is a non-amortized debt. What does that mean? We know what amortization is. Amortization means you're paying back your debt uh, in installment, and then that installment, in other words, monthly payment, breaks down into interest and principal. So, in other words, in amortization, you pay back principal and interest little by little. But in case of bond, you pay interest until maturity, and then at maturity, you pay back the par value, right? So it's non-amortized debt, non-amortized. Okay, entire principal is repaid at maturity. Coupon means interest, right? And I told you, now, and how do we value the bond? Of course, there are two types of bonds we all understand: zero coupon bond and coupon bond, right? Coupon bond is interest bearing bond, it pays interest. Zero coupon, it doesn't pay any interest. Okay, so let's take a look at the zero coupon bond case first. And you understand zero coupon is exactly a single cash flow present value, right? Why? Uh, let's take a look at this. Bond with par value of 1,000, of course, 1,000 is the par value for most bonds. Maturing in 20 years, maturity is 20 years, timeline 20 years. And price to yield 6%. What does that mean? Price to yield 6%. That's the way. That's the way it is worded. In other words, that means this is the discount rate. Use this. They never tell you. The problems will never say this is the discount rate. Use this as discount rate. It will never say that. Uh, uh, on the other uh, on the other hand, uh, the most common way it is worded is that um, there are three ways. The prevailing market rate is 6%. One, the prevailing market rate is 6%. Two, similar bonds pay 6%, or comparable bonds pay 6%. Okay, what does that mean? Similar bond, what does similar bond mean? Similar bond means the bond, similar bonds mean the bonds of the same same risk class. Okay, the bonds of the same risk class. So if this bond is double A bond, that means other AA bonds also pay about 6% on average, right? That's what it means, you know. Other bonds of the same risk class are paying 6% on average. Then you use 6% as the discount rate. That's what it means. Well, that's the second way. And the third way is that the bond is priced to yield 6%. What does that mean? If you use 6% as the discount rate, that is the price, the present value, the price of this bond. In other words, use discounted with 6%, then that's the present value. If you discount it, that's the present, that's the price. So, in other words, this is a straightforward present value problem. Isn't that right? Why? Okay, in this example, you can summarize it like this. Oh, where is that thing again? Okay, here. Open up. Where is it? Okay, it's taking forever. It's almost. Whiteboard, please. Whiteboard. What happened to the whiteboard? I'm having really Jesus, this I gotta the only reason I'm using this Chromebook is because it's touch screen. If it isn't, if I can find but you know, Chromebooks have very small RAM, so you cannot run multiple programs, you know, smoothly at the same times. That is the so come on, let me. Okay, then it's gonna take a lot of time, so let me use another one. Okay, let's see. What is this? All right. Okay, so we're back to square one. Oh, this is crazy. Okay, and I have this thing, but it's not. It's not. Okay, so I don't have too many options. So I'll just have to use this. Oh. Come on. I can't even find my cursor. Excuse me. I think I better just close down everything and re-log in or restart the computer. Give me about 5 minutes. Oh, okay, now. So let's the few okay, can you hear me? Can you hear me?
Yes.
Okay, good.
Yes.
Yeah, I'm sorry. My computer crashed for a while and it just, automatically restarted. So, um, so I have to. I think I lost some setting, and so it's not sharing. I mean, this. It's a good thing that the recording kept going, or at least connection to the Blackboard wasn't lost. But I'll have to share again. I think it's. So it was slowing down so severely. Wasted at least about 10 minutes because of this. Okay, so let's go back to Okay, here's my whiteboard. You see my whiteboard now, right? You see my whiteboard? Do you all see my whiteboard?
Yeah.
Okay, good. So, as I said, discount bond is a straightforward present value problem, right? So our $1,000 face value, that is, basically, the future value, right? And then in our example, where did it go? 6% was the discount rate, but that's APR. So since M is 2, right, we have to always assume that, in bond problem, M is always 2. Then, 1.03 raised to, what was the maturity? Wasn't it 20 years? I think it was something like 20 years. There you go.
Yeah.
Okay, then we all know N, so T is 20, so N is 40, right? So it's very straightforward. So here, 1,000 over 1.03 raised to 40, and then it comes to 306.56. Okay, so this is the fair value or rational price of the bond. Why I'm saying is fair value or rational price, which means if there is a if there's rational value, then that means there's irrational value. Yes, then market price may not be exactly the same thing. Why? In case of bond, market price is pretty much okay, whatever it comes to 3 or something, right? In case of bond, market price is not that much different from market price of the bond, right? Market price of the bond is not that much different from the rational price, because there's no there's very little uncertainty, right? So I personally, I use this symbol B for rational price of the bond and P for market price. Okay. In case of bond, there isn't that much difference because there isn't that much, uncertainty. But in case the uncertainty about, something like this, what would be the what if there is inflation, right? Of course, even if there is inflation, this doesn't change. I mean, because that's the average of that's the prevailing market rate. That means that's average of what the other bonds of the same risk class are paying, right? So bond has relatively less uncertainty. If ever, the only uncertainty is about what's going to be the future of inflation and what's going to be the future rate change. Okay, but in case of stock, there are so many uncertainties. There are many risk factors. Therefore, in case of stock, I use this for the rational price and P as the market price. There's always, market price and rational price can be significantly different. I mean, market price can be greater, or if market price is greater, then that means it's overvalued, right? If market price is less than the rational price, that means it's undervalued. or hardly, very rarely they can be equal. In case of bonds, still, even though they are almost, no, because there's very little uncertainty, they will be pretty much equal. But still, even by a very insignificant amount, by very small degree, there can be difference. And think about it. This slight difference is what always makes the market. In other words, uh, if it is anything is undervalued, then that's a short-term window for making profit. If anything is undervalued, right? You buy the undervalued asset and you sell the overvalued asset, right? That window of opportunity is very brief, but that is definitely the even a uh, small difference. But you are when you're dealing with like $10 million, even a small difference of 1% would make. I mean, 1% of 10 million is what 100,000, isn't it right? 1% of 10 million is 100,000. I mean, 100,000 is somebody's annual income, and it's a very decent income. You can make that in a split second, right? So everybody's on a hunt for undervalued asset. Now, so that we understand now how then how to okay, where is it? Okay, so it's not so it's straightforward. And then what about the coupon bond? In case of coupon bond, it is annuity, right? Why? Annuity and a single cash flow together. Why? Let's take a look at this. A bond has 10 years to maturity, a par value of 1,000, and the coupon rate of 10%. What cash flows are expected from the bond? Annuity cash flow. Why? Coupon rate is 10%, then it's annually $100. Interest is annually $100. Isn't that right? Interest is annually $100. And then, although bonds pay interest semi-annually, let's forget, I mean, just ignore that for a while and just assume annual interest, right? They pay annually. Then $100 at the end of every year for the next 10 years, right? So 100. So that's an annuity, isn't it right? Ordinary annuity. Cash flow is ordinary annuity, and at the end of year 10, you get 100 plus the par value, right? So then, now what is the you might have this aha moment now. I mean, if you understand what I'm talking about. Oh, then the bond price is the present value of all those annuities plus the present value of this 1,000, right? Isn't it right? So I'm not gonna all you need to do is then, so mathematically the price of the bond, right? So I should actually use B for this, but in the old days I used P sub B, price of bond. But this is rational price, so B should be a better symbol for rational price of bond, but that's my symbol. I use B for that. Most other people would still probably use P. And because in case of bond, the rational price and the market price are not that much different. The only difference, only source of difference in the market price is the dealers, because brokers, right? Why? Because the bond is sold generally through in large lots, large quantity, um, uh, through brokers, bought and sold, through brokers. Um, so between the broker and the broker, right? Uh, they will just determine how much commission they will take from that, and add the commission, that kind of thing. So price is already quite obvious, but then adjusting for broker commission and transaction fees, the market price would be determined by that. Um, because everybody can easily know, as long as you know the math behind it, everybody can easily calculate it. So and there aren't that many uncertainties surrounding the bond, because what is the uncertainty? I mean, cash flow. There is no uncertainty about the cash flow of the bond, isn't it right? Cash flow of the bond is quite obvious. It's already predetermined coupon interest rate. So if the coupon interest rate is 10%, and if the maturity is 10 years, we know we will get $100 at the end of every year for the next 10 years. So there is no uncertainty about that cash flow, and even the capital gains, capital loss, right? We have no uncertainty. I mean, if it is selling currently for $800, and if I hold it until maturity, I will make $200 in capital gains. So everything is quite certain about the bond. So there is nothing that will make pricing a gray area. Everything is quite clear. So the market price is only reflecting some broker fees, commissions, and some transaction costs. That's it. Now, so mathematically, it's annuity, present value of annuity, and those annuities are coupons, and then single cash flow. Excel has price function. I'm not going to talk about it. I'm going to maybe later. So here, consider a 20-year bond with 7% coupon. So we know interest, annual interest is $70, but half year, 6 month, semi-annual interest is $35 then. 20 years, timeline is 20 years. That means 40 semesters. N is going to be 40. All we need to know is what's the discount rate. And I told you, they said discount rate is 6% annually. But I told you, this is not the way it is worded, right? This is not the way it is worded. Always, though, it is worded as what? Prevailing market rate is 6%. Prevailing market rate is 6%. 2, comparable bonds or similar bonds yield or pay 6%. 3, the bond is priced to yield. 6%. Okay, the bond is priced to yield 6%. So that's the way, one of those 3 ways, or maybe there are other ways to word it, but it never, you would never expect it will hardly be. Where is it? Oh God. Right? It will never be. They will never tell you straightforward. Use this as discount rate. But anyway, we know what to do. It looks quite complicated, but as I said, this is one variant of the formula but if you distribute all these numbers, you will see this is what payment over times 1 over R, right? 1 over R minus 1 over R times. I mean, if you this thing got looks more complicated because I don't know why this is like fraction over fraction. Oh, that looks stupid. But it's eventually 1 over R minus 1 over R times 1 plus R raised to N, right? So I still like that. So we'll and before we even do that, let me ask you. I mean, you can tell whether this is going to be even before you calculate it, even from this already, even from the setup, you can tell whether it's going to be a premium bond or discount bond. We know, looking at the result, it's a premium bond, but even before you do the calculation, you should be able to tell it's going to be whether it's going to be premium bond or discount bond. Can anyone tell me why we can already tell? Can anyone tell me? I think if you answer this is at least 1 point question. Anyone?
Because the coupon rate is high?
Yeah, higher than what?
Higher than the risk-free return.
Basically, you got it right. The coupon rate is higher than the discount rate, right? And I've been telling you, if the coupon rate is higher than the discount rate, then it becomes premium bond. And if it is the other way around, vice versa, it will be a discount rate, right? Higher coupon rate. Why? Because the discount rate is what? That's the prevailing market rate. Prevailing market rate. So if this pays higher interest than the prevailing market interest rate, everybody will run to buy this bond. Isn't it right? I mean, it's just 1% difference. You might not be tempted that much, but if you're managing something like $100 million, suppose you're managing $1 billion, 1% difference will make what? 1% of 1 billion is what? 10 million is 1% of 1 billion. Isn't that right? 1% difference will make that much difference. I mean, if you're a portfolio manager, fund manager, and with about $5 billion under your management, 1% difference, right, is huge, right? So even you might, it's just 1%. I mean, if you're dealing with only about $1,000, it's not that appealing. But if you're dealing with something like in the order of, the amount in the order of billions of dollars, then 1% makes a huge difference, right? So you can already tell that this is going to be a premium bond, and do the calculation. It's not a difficult thing. And we'll do this on Excel, but for now, just to set it up. So think about it. Coupon rate is 7%. So discount rate 3.5. So that means payment every time is going to be $35, right? 1,000, right? Times 3.5. 20 years left, right? So N is 40 semesters. So what's going to be the price of this bond? Raised to N plus face value. So plug in the numbers. 35 over $35 over 0.035. Oh no, I'm sorry. Oh, that was coupon rate. I messed it up. So here it has nothing to do with so discount rate is 3% because APR, the discount rate 6%. So that means R is 3%, right? So it's like this, minus 35.03 times 1.03 raised to 40, right? Plus 1,000 over 1.03 raised to 40, right? Raised to 40. And do this, and you calculate this. I mean, we're gonna do that on Excel. But anyway, the point is, so that will bring us to come on, open. Okay, it will bring us to 1100, 15, and 57. So it's clearly premium bond, and most of the value is derived from what? Annuities. We can see most of the present value is derived from the annuity, right? The present value of 1,000 when discounted is only like oops, what's going on? 306, right? The present value of all those coupons is 809. Okay, so so next example, determining rational price of bond. Rational price, the price that we find by using this discounted cash flow model. Okay, discounted cash flow model, another terminology. This is discounted cash flow model, right? This is this. Why? Because what are we doing? We are discounting the cash flows. We're discounting the cash, right? We're discounting. So present value is basically discounted cash flow model. Present value is discounted cash flow, right? Finding the present value is through discounted cash flow model. That's rational price. Because why is it rational? Think about it. What else is expected? What else is expected from the bond? Price of any financial asset. Price of any financial asset is the present value of all its future cash flows. That's a very rational thinking, isn't it right? It's a very rational thinking. What else is there? It's the present value of all its future cash flows. Nothing else. So that's the rational thinking. That's why it's called rational price. If you think there is anything else, in case of stock, it's the same thing. Rational price of the stock is the present value of all its expected future cash flows. What else can be there? But then again, expected future cash flow. There is a expected cash flows are relatively relatively known, which is dividend. Dividend is expected cash flow, but then the dividends fluctuate. That is that doesn't make it as simple as a bond valuation, right? And also, but that's rationally what is rationally expected. And other things are all ad hoc factors, right? Ad hoc, Latin for everything else is ad hoc factors. Like the Fed decision, inflation, interest rate. All these are, and also other risk factors, right? Risk factors, which are rather ad hoc. Because what's going to happen to the inflation? What's going to happen to the interest rate? Because interest rate is important because it is basically the discount rate. When there is no better, and other risk factors, that can be influenced by many things, systemic and non-systemic. But but that's still quite that's still quite variables that we can expect. But sometimes what else? Like war in Ukraine. We didn't think actually we never during this time of pandemic we never thought. I mean, we thought that Russia would invade. We could guess, but that was just a guess. I mean, all speculations. But with probabilities, there's a 60% probability that Russia would invade, or high probability, 85% probability, but it's not 100%. Those things are ad hoc. Only when it happened, it's 100%. Or coronavirus variant. I mean, we thought we were almost recovering from COVID, but then new variant BA.5. All these things. Those are ad hoc factors, right? In stock, that ad hoc factors can play. It can play into the market price of the stocks. So in case of stock, the difference between the market price. That's why the difference between the market price and the rational price is significant, right? But anyway, determine. So this example, let's take a quick look. The Emory Corporation issued an 8% 25-year bond 15 years ago. At the time of issue, it sold for its par value of 1,000. So here, two things. One, 15 years ago, it was 15 years ago, right? And at the time, the maturity time left was 25, but that was 15 years ago. So now the time left to maturity is only 10 years, right? You understand? At this point, there's only 10 years left. And then when it was sold, it sold for its par value. Then what does that mean? What kind of bond sells at par value? We can also tell from this what was the prevailing market rate at the time, 15 years ago. You understand? You understand what I'm saying? DeAndre, a while ago, DeAndre gave me the answer. The question, answer to the question, what was the, where did I put that paper? I will. I'll have to. So, DeAndre, you got 1 point for that. But where's the? Okay. And what was the question at the time? Why was how do you know it's gonna be a premium bond? And DeAndre's answer was because the coupon rate is greater than the discount rate, right? Then think about it. And this was also discussed in topic 1. The bond can have 3 possible ranges, price ranges. One, market price being greater than 1,000, which is the par value, right? Or equal to 1,000, or less than 1,000. Only 3 possible price ranges. And if it is above 1,000, selling above, if the price is above 1,000, it's called premium bond. And if it is less than 1,000, discount bond. And if it sells exactly at 1,000, then there's no particular name. You just say it sells at par value. Logically, think about it. What makes it premium bond? DeAndre already answered. And then what makes it discount bond? It's the opposite. It's exactly the mirror image of the premium bond, right? Then the answer would be logically already deduced, right? Answer can be deduced or deducted. I think deduced, that's the right word. Answer can be logically deduced already. Then what conditions would make the bond sell at par value, right? Now, although I'm gonna leave that question as a food for thought, okay? Because we are it's almost time 8:09. I think I'm gonna call it a night here. So we're gonna pick it up from this example tomorrow, and tomorrow as an opening remark, I'm gonna bring this up again, and I want you to be ready to give me the answer. What kind of conditions will make the bond? We already know the answer, and nobody's telling me. So that's the problem. I mean, if that's the time you will get at least 1 point. All right, so I will. So that's it for today, and if you have any questions, please email me. And I guess we have about technically 5 minutes, but I don't think I cannot answer any long any question that would require a long answer. So I'll say good night, everyone, and I will see you all back here tomorrow. Okay. All right, then I'll
good night.
stop recording. All right, good night. Take care, everyone. Stop recording.
Bye.
Good night.